What's up, guys? John here. Credit card companies have just declared war on America. All retail credit cards are going to be going from 35% interest all the way to 39.99% interest. On top of this, all credit card companies are going to be charging a fee to mail you your statement. You know, that statement you get, you take a quick glance at, you rip up, you throw it in the trash. It's going to cost you $1.99 a month going forward. On top of this, they're finding all of these different loopholes and ways in which they can extract as much cash from you as possible. And why is this? Well, President Joe Biden attempted to push forward a law that got blocked by a judge on Friday. And this law was to reduce late fees from $32 to $35 all the way to $8.
A new rule limiting excessive credit card late fees.
The Biden administration's plan to make those fees max out at $8.
A federal judge has blocked the Biden administration's attempt to cap credit card late fees.
Now, many people think this is a great thing. They are going to save Americans money. But what they didn't realize is that right now Americans have $1.129 trillion in outstanding credit card debt. And credit card companies have no usury laws, meaning that they can charge any interest rate that they want. There's no protection at all for the consumer. It's unlike, you go to a payday lender, an installment lender, go to a local bank, and they have to abide by certain protocols and policies and interest rates. It's not like that with credit cards. And so you think about this. They say that they want to reduce the fees, right? But then they push credit card companies into a position to where they just get filthy rich off of Americans. And who's going to benefit? It's going to be Wall Street. They pretend like that's a great solution for Main Street, but at the end, Main Street gets stiffed again. In this video, I'm going to break it down and show you exactly what's going on to help you and position you for what I believe is going to be a lot of change coming for America, and exactly what you should do right now if you have credit card debt. Please hit the like button, hit the like button, people share the content, educate more people about what's going on in America's economy. If you'd like to fix your credit to position yourself for what I believe is going to be the greatest wealth transfer in American history, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item in a credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free call for tomorrow. Take a look at this. So, shocking. 35% rates continue in retail cards. And so what they say here is that if you miss a payment and there's a penalty rate, which could still be applied when customers are late, would go up to 39.99%. 39.99%. Credit card rates on store-issued credit cards are typically much higher than regular cards, but a rate of 35% really can cause your eyes to pop. Now, they say that the average rate right now on a retail card is about 29.33%. Now, what's very fascinating is when you look at what the real interest rate is for a normal credit card, is about 27.64%. 27.64%. And so here are some of these new changes that are coming. So they're going to be charging you a fee for paper statements, about $24 a year, and they're going to be charging you a monthly fee of about $1.99. So they say that they need to charge these fees because it's, a way in which they can offset their losses potentially from this, reduction in their fees for the late pays. But they also say it's going to be great for the environment because the environment, isn't going to be suffering, all of this paper that's going to be mailed out all throughout the country to tens of millions of Americans. They can sign up for online digital statements and save the $1.99 a month, right? So this is what they're saying. So when you start to kind of connect the dots here, it's very, very fascinating how this whole situation just happens to benefit them so much and completely stiffs America. So, for example, in 2023, the average balance on a credit card was about $6,500. $6,500. Then it increased. Look how much it's increased. Now they're saying that the average balance is $7,951. So it went from $6,500 to $7,900 in the course of, literally talking a couple months. I mean, look at this. This came out March 11th, 2024, about 2 months ago. And then you have this, came out May 8th. It jumped $6,500 to $7,900. That is a massive jump. And so what does this look like for Americans? Let's say, for example, you have $6,500 in credit card debt, and the average interest rate is 27%. We'll go low end. This is Forbes. We'll go low end. They're saying 27 point, almost 28%. It would take about 3 years and 7 months to get out if you're putting $240 a month towards this payment, which is pretty substantial. Most people would not put $240, they probably put $150, $180, but you're looking somewhere around 3 years, 7 months. If interest rates go to where they're saying they're going to be going, because there's no protection at all for consumers, say they go to 35%, it would go from 3 years, 7 months and about $3,600 to a whopping 4 years, 7 months and $6,500. This is on $6,500. But now the average balance is, $7,900, $7,951. And so when you look at what this means, on $7,951, this would push someone to almost a decade's worth of debt pay down. If they're paying $240 a month, $20,000 in interest they would pay back on $7,900 in principal. Again, it's absolutely shocking. In 2020, for context, average interest rate is about 14.5%. And so what this means is that on 14.5%, you'd go from paying $20,000 in interest on 35% interest rate to $2,000. So even if it's at 27%, like where it is right now, 27% is 3 times the amount of interest. 3 times the amount of interest. So every time that they increase rates, whether it be directly the Fed, whether it be the credit card companies themselves forming a monopoly and working together. I mean, look at Discover. Discover was just acquired by Capital One for $35 billion. You have all these companies, moving against the consumer. It's going to put them in such a strong position to, I believe, change America. I mean, look at this, for example. Credit scores decrease for the first time in a decade as more borrowers fall behind on payments. It came out a couple months ago, right? And so here's how bad the situation is. No state had credit card delinquency rates less than 10%, with Iowa coming at the closest of 12.9%. So, I mean, you see all of these states at 15, 20, 30%. I mean, some almost 40%. You see all these states hovering around 20% default or delinquent. What is this going to mean? Well, it's going to mean credit scores are going to go down. People are going to get more and more desperate for credit. And these companies are going to be able to bring forward products and offers to completely screw the consumer. Because those that have great credit, those that are, they have very little consumer debt, are going to have an upper hand inside of this, new normal. They're going to have an advantage over everybody else. And what I believe is going to happen is I believe credit card companies are not just going to increase rates once or twice. I believe going forward, next 3 to 5 years, as we're going to start moving into this digital world, where everything's going to be digital. But from the next 3 to 5 years, I believe credit card companies, all they're going to do is they're going to keep hiking and hiking and hiking the rates on consumers. And that's why right now, if you have credit card debt, you have to build a plan to get out from underneath of it, because they're going to keep stiffen you. I'm telling you. I mean, look at this, for example. When you go from 14%, and most people, if you're a small business owner, most small businesses have a lot more than $8,000 in credit card debt. I mean, if you have $20,000 in credit card debt, you look at these numbers, I mean, it's shocking. Even if you says you have to pay $450, say you pay $460 a month on this balance, you're looking at $60,000 in interest. $60,000 in interest. A lot of these small business owners are doing this. 43% of all small businesses missed rent for the month of April. 43%. They employ over 60 million Americans. So I mean, it's a really, really big problem that is forming right now for American consumers, and they bring forward all of these solutions to help consumers, saying they're going to reduce fees and they're going to do this, they're going to do that. But at the end of the day, every single thing that they attempt to do, on both sides of the spectrum, it always just benefits the big donors. It always just benefits Wall Street. Wall Street always just gets bigger and stronger and more rich. That's generally what happens every single time. Now, what I find very fascinating is kind of how this all works and what people can do about this. So right now, if you have, let's say, bad credit or you have no credit, what you should do is look into a secured card. Now, you can apply for a secured credit card free. It basically operates like a debit card. You sign up, and some of these have where you don't even need to apply. You don't have to put your social. You don't have to give any of that information. And all you do is you put $200, $300, $400 on a card. You use the funds and you continue to refurbish the account. Put the money back in, and after 6 months, you'll start to establish a solid line of credit. Now, this is not going to help if you have a bunch of late fees or late payments. You have a bunch of issues on your report. This isn't going to help you there. But if you don't have much of a, in terms of a credit history, this could greatly help you. If you have any of these issues, you definitely want to square away late payments and things like that, because they're going to stay in your report for 7 years. and they could drop your score. One late payment can drop your credit score a whopping 180 points. And so what I believe is going to happen right now is we're going to see defaults continue to skyrocket as interest rates continue to go up. And as defaults continue to skyrocket, what's generally going to happen is credit card companies are going to continue to offset their losses by increasing rates more and more and more and more. It's going to be a never-ending cycle. However, I believe from now until maybe the end of the year, we're going to see balance transfer offers still available. If you don't know what that is, let's say, for example, you have a $20,000 balance here. And let's say you have a credit score of 650 or 670, in that range. If you were to somehow get your score to 740 or 750, and you were able to transfer that entire balance, and you were able to go take the same monthly payment, the 460, but instead of paying 27% interest, you're paying 0. It's not going to let you put 0 here, but say you're putting 1. You go from 14 years to 3 years, right? And you pay $379 in interest on that specific scenario. Now, most of these credit card companies they'll grant you 12 months, 24 months, 18 months in that range to pay off your balance. So if you can somehow find a way to pay $550 a month on that same exact balance, you will end up, maybe $600 a month. You'll end up paying that balance off, before the expiration or right around that expiration. You have to play with the numbers for your specific scenario, but you'll be able to get out of debt interest-free and put that money into maybe your education, maybe into buying your first home, buying a car. But you want to really exercise the options that are available to you now if you have credit card debt, because I believe a lot of these options are going to slowly start fading away as credit card companies realize how much authority and power they really have when they have consumers on the hook for $1.129 trillion and they have no limit in terms of the interest rates that they can charge. It wouldn't surprise me to see interest rates go into 35, 40% on traditional cards, and even seeing retail credit cards go into 40% or 45%. It might sound far-fetched. Some people say that'll never happen. Look, interest rates on credit cards, looking just a couple years ago, you're at 13%. 13%. Looking back 7 years ago, even in this range, 14%. It was very, 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 very expensive in relation to what it is today. So if it can go from 13% to 27%, there's no way saying it's going from 27% to 30 or 32 or 35% of regular credit cards, and retail is not going to 40. I think that's the trend we're going. And so if you have great credit, you're in a really, really good position. If you don't, I'd square it away now. If you need to build credit, I look into secured credit cards. I would find ways in which you can put yourself into a position to have more relationships with more banks, more lenders, more credit card companies, and do everything you could possibly do to open up more opportunities, because I believe some doors will close, some will open, and those that have more options will likely benefit. And what do you think about this entire situation? What do you think about this $8, late fee cap that was attempting to be pushed forward? Somehow just greatly enriches all the credit card companies and greatly negatively impacts America. Let's talk about it in the comments below. If you need help fixing your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any issue at all in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free call for tomorrow, for Tuesday. Catch you next video.